Imagine digging into a company, like really digging in, so thoroughly you could actually see past the public numbers, get a feel for its true hidden potential. Well, today, that's exactly what we're doing. We're taking a deep dive into TriMas Corporation, ticker symbol TRS. They're a diversified global manufacturer. Right now, they seem to be undergoing some pretty significant strategic shifts. So the big question we're tackling for you is this. Is the market truly appreciating the transformation happening right now? Especially when you look at, well, some surprising insights into its intrinsic value and, get this, massive insider conviction. Our analysis is fresh. As of August 9, 2025, the common stock closed at $35.53 a share just yesterday, August 8th.
Yeah, and our mission today is really to cut through all the noise, unpack the most crucial nuggets from the source material you've gathered. We want to make sure you walk away feeling well-informed on TriMas, understanding its business, the management, the financials, market sentiment, who owns it, and of course, the key risks. Everything we talk about is really designed to help you grasp what truly matters here.
And just a quick heads up for everyone listening, we are going to be covering TriMas Corporation's Q3 2025 earnings, like within minutes of their release. So definitely stay tuned for that upcoming deep dive. Okay, let's kick things off then. Chapter 1, business analysis. This is where we sort of lay the groundwork. All right, let's unpack this core question. You've got a new CEO, highly accomplished, comes straight from the packaging industry, taking the helm, and there's this strategic pivot away from some, let's call them legacy assets. Yeah. So is TriMas finally positioning its high-margin, technically advanced segments to, unlock shareholder value that might have been masked by its conglomerate structure?
That's precisely the puzzle, isn't it? And TriMas operates under something they call the TriMas business model, or TBM. You can think of it as their guiding star, maybe a discipline system for achieving long-term performance. It really emphasizes operational excellence, continuous improvement through Kaizen, developing talent, and importantly, flawlessly launching new products. It's their core blueprint.
And this blueprint, it applies across their three main business segments, right? The biggest is TriMas Packaging, that was about 52% of their 2023 net sales. Then you've got TriMas Aerospace at 27%, and Specialty Products making up the other 21%. They really seem to lean into this philosophy of balance through market diversity, which I guess is essentially a way to protect themselves against big macroeconomic swings in any single industry. Seems smart.
It is a smart move. And, to paint a clearer picture, let's look at what they actually do. In TriMas Packaging, they produce these highly engineered dispensing and closure systems. Okay. So think about the foaming pumps on your hand soap, or precise lotion pumps, trigger sprayers, specialized food lids, child-resistant caps. But the key thing here isn't just what they make, it's how these niche specialized components create incredible customer stickiness. Once a component like a rake pump that's one of their major brands is designed into a customer's product, it's incredibly hard and costly for competitors to just swap it out. They also make critical components for life sciences, things like pharmaceutical packaging, diagnostic test kits, that's under brands like Afba and Ferrari and Taplast.
Okay, so high-value, hard-to-switch components. Got it. And for TriMas Aerospace, what's the story there?
Aerospace is all about precision. Highly engineered fasteners, collars, blind bolts, rivets, complex ducting systems. These are definitely not off-the-shelf parts. They're mission-critical for commercial aircraft, business jets, military programs. They supply directly to the major OEMs, that's original equipment manufacturers, Boeing, Airbus. Think Monogram Aerospace Fasteners, another one of their well-recognized brands. They provide parts where, frankly, failure just isn't an option.
Right. And their third segment, Specialty Products. What role does that play?
Specialty Products is mainly Norris Cylinder. They manufacture steel cylinders for compressed gases used in industrial settings, healthcare, construction. But what's really important to note here is how they've actively reshaped this segment. They strategically divested their aero engine business back in January 2025. Now, that was a very deliberate move to get out of the cyclical oil and gas market. It allows them to refine the portfolio, focus capital elsewhere.
Okay, so TriMas might not be a household name, but clearly a significant player in these specialized, often critical niche markets. They've got a global footprint, about 900 employees across 13 countries. Their trailing 12-month, or TTM, revenue is roughly $974 million, and their market cap is sitting around $1.45 billion right now.
Yeah, and their core value proposition really boils down to being a technology partner, not just a supplier. They're not trying to compete on price alone. It's about providing innovative, proprietary, highly engineered solutions. And this naturally leads to deep, long-term, collaborative customer relationships, which in turn translates into secured replacement business and that very sticky customer base we mentioned. Once you're designed in, you tend to stay in.
This next point feels really crucial. Let's look at the industry trends and growth potential, especially in their two primary industries. For packaging, it seems like it's undergoing this massive transformation. It's driven by sustainability, things like monomaterial designs, refillable solutions, even smart packaging. And e-commerce is also fueling demand. I mean, the North American flexible packaging market alone is valued nearly $85 billion this year, 2025. That's a huge tailwind, right?
Absolutely a tailwind. And then in aerospace, we're seeing a really strong upcycle this year. There's this global resurgence in air travel, which is leading to record production backlogs at those big OEMs like Boeing and Airbus. That directly benefits TriMas's specialized components. Plus, there's growing demand for MRO, that's maintenance, repair, and overhaul services, and an increasing focus on supply chain resiliency, even AI integration for things like predictive maintenance.
So what does the competitive landscape look like for them? Are they battling giants or more like smaller specialized players?
It's really a mix. In packaging, yeah, they compete with large global players, Aptar Group, Amcor, but also smaller specialists. For aerospace and specialty products, it's more diversified industrial manufacturers, think ESCO Technologies or Barnes Group, plus those highly specialized suppliers like Precision Cast Parts. But TriMas's strategy, again, it isn't just about sheer scale, it's about leveraging their deep engineering expertise, that constant innovation, and the strong customer integration we talked about.
They also operate in some really demanding regulatory environments. And surprisingly, maybe, this isn't just a hurdle, it actually acts as a significant competitive advantage.
Oh, absolutely. Think about packaging. They're dealing with stringent FDA and EFSA regulations, especially for anything touching food or pharmaceuticals, plus global environmental legislation, the EU Green Deal, various plastic taxes. And in aerospace, it's even more rigorous. You've got the FAA and EASA heavily regulating safety, the U.S. Department of Defense for military products. These regulations create incredibly high barriers to entry for any potential new competitors. In packaging, it's the capital investment needed, the complex environmental rules. In aerospace, it's literally years of expensive certifications and OEM qualification processes. It builds a really robust moat around their business that's very hard to breach.
Exactly. And that leads perfectly into their other competitive advantages. Beyond that regulatory moat, they have strong brand recognition names like Reek, Monogram. They also pursue cost advantages through their TBM framework, lean manufacturing, and that global footprint, including lower-cost regions like China and Mexico. But maybe their most durable advantage, especially in aerospace, is those incredibly high switching costs. It's just too costly, too time-consuming for an aircraft manufacturer to re-engineer or recertify a component if they wanted to switch suppliers once a part is designed in. It's almost prohibitive.
And let's not forget their unique assets, mainly their intellectual property, proprietary manufacturing processes, product technologies, and this isn't just a claim. They assert it's difficult and costly for competitors to replicate. This technological depth, built up over decades, that's a key differentiator. Okay, now let's shift our focus. Let's move to Chapter 2, Management Evaluation. And here, a really significant story is the leadership transition we saw in 2025.
Yeah, that was a big one. The new CEO, Thomas J. Snyder, he stepped in June 2025. He's a veteran of the packaging industry, nearly 35 years experience, including leading a $3 billion division at Silgan Containers. His track record for driving growth seems impressive, and his appointment really signals a focused strategic shift towards boosting that packaging segment.
Right. And providing stability during this transition is Teresa M. Finley. She was appointed interim CFO back in March 2025. She's not a newcomer, though. She's been on their board since 2020, brings 34 years of senior financial experience from UPS. Her deep expertise and, existing familiarity with TriMas are a huge asset right now. It's also worth mentioning the previous management team showed real resilience. They navigated challenges like COVID, demand softness in 2023 through focused cost management, operational improvements.
And when it comes to communication and ethics, the sources seem to highlight pretty high standards. Detailed quarterly releases, public conference calls, they operate under a formal code of ethics. Seems like no major scandals. And they even successfully defended a patent suit back in 2014, which shows commitment to protecting their IP.
Definitely. In capital allocation, that's a core part of their strategy, and it's really instructive to look at. They aren't just relying on organic growth. They're actively augmenting it with what they call programmatic bolt-on acquisitions, and their focus is sharp: packaging and aerospace, especially those high-growth niches like life sciences, beauty, defense. We've seen this play out with acquisitions like GMT Aerospace in February 2025, Arts Packaging in 23, Intertech Plastics in 22, even Omega Plastics and TFI Aerospace late in 21.
But it's not just about buying, is it? They also seem to have a very clear strategy of shedding non-core assets. Like that aero engine business they divested in January 2025. That was a deliberate exit from the volatile oil and gas market. And that move allows them to redeploy capital into those higher growth, higher margin businesses. It really demonstrates a disciplined, focused approach to portfolio optimization.
Absolutely. And they seem committed to returning capital to shareholders, too. They're an active share repurchaser, bought back over $19 million in 2024, $18 million in 2023, still have over $65 million left on their authorization. The dividend policy is stable, a quarterly cash dividend of 0.04 cents per share, so $0.16 annualized. It's been consistent for years, although granted without recent growth. The current yield is around 0.46%.
Okay, so with all these strategic moves, the acquisitions, the divestitures, the focus, what does it all mean for a critical metric like return on invested capital or ROIC? Their trailing 12-month ROIC seems quite low, right? In the range of 3.0% to 4.4%. That's a fraction of what you see in high-quality industrial peers like Illinois Tool Works at over 28% or Dover over 13%.
Yeah, and that low historical ROIC is a real point of concern for value investors, no doubt about it. But by OIT, and this is the crucial context, it absolutely must be viewed in light of their strategic transformation. The divestiture of Aero Engine, acquiring higher margin businesses, the new CEO's operational focus, these are all precisely aimed at significantly improving this metric going forward. So you could argue investing in TriMas right now is, in many ways, a bet on this management team's ability to actually elevate that future ROIC. Okay, now let's dive into the numbers. Chapter 3. Financial analysis.
Right. First up, let's just quickly look at their market cap, about $1.45 billion, puts TriMas squarely in that small mid-cap segment.
And over the past 5 years, TriMas has shown pretty consistent revenue expansion. They grew from $770 million back in 2020 up to $925 million in 2024. That reflects, a steady combination of organic growth and their acquisition strategy playing out.
And when we look at profit margins, their trailing 12-month figures show, gross margin around 22.6%, operating margin near 6.8%, net profit margin at 3.8%. But, and this is where it gets interesting, Q2 2025 saw significant improvement. Adjusted operating margin was up 3 percentage points to 11.6%. Adjusted EBITDA margin up over 2 percentage points to 17.4%. So that suggests those TTM figures might not fully reflect their current, maybe improved profitability potential.
Exactly. Now, free cash flow, or FCF, generation over the past 5 years, it's been consistently positive, but it has fluctuated. They generated nearly $48 million in FCF in 2023, which then softened to just under $30 million in 2024. However, cash generation showed renewed strength in Q2 2025, reaching nearly $17 million. That's a notable jump from about $11 million in the prior year period.
Now, let's talk earnings consistency, because at first glance, it looks pretty volatile. Net income dropping from over $57 million in 2021 down to $24 million in 2024. That sounds like a potential red flag, doesn't it?
It does on the surface, and that's a fair observation. But when you dig a bit deeper, there's nuance. That 2022 peak, it was actually inflated by over $22 million in non-recurring gains from selling property. And the 2024 decline was largely due to a sharp cyclical downturn in their specialty products segment. But crucially, management has already addressed this volatility by divesting Aero Engine. So the underlying earnings power of their core packaging and aerospace segments has actually been much more stable and robustly growing, which means those historical reported earnings might not be fully representative of the refined portfolio's future power.
Okay, that context is absolutely vital. So what about their overall financial stability? Debt levels, liquidity?
TriMas maintains a, I'd say, moderately leveraged balance sheet. Their debt-to-equity ratio is around 59.5%, net leverage at 2.6 times. What's reassuring is they have no significant long-term debt maturities coming due before 2029. That gives them substantial financial flexibility. Their current ratio is also robust at 2.59, indicating a very low risk of any short-term financial distress.
Right, and as we mentioned, that $0.04 per share dividend has been stable, consistent, although no recent growth.
Now for valuation, this is interesting. On a relative basis, looking at PE ratios, TriMas stock actually appears quite expensive. Its trailing 12-month PE is around 38.3 times earnings. That's significantly higher than its industry average of 23.5x and its own historical range, which has gone as low as 17.8x. It's also higher than direct competitors like Mueller Water Products or Aptar Group. So this high multiple strongly signals that the market has already priced in some pretty significant future growth expectations.
Okay, so how do we look past those market multiples then? How do we try to understand its true, maybe fundamental worth
Well, that's where intrinsic valuation comes in. And a discounted cash flow, or DCF analysis, is a really powerful tool for this. Essentially, it estimates a company's current value by forecasting all its future free cash flows, that's the cash available to the owners after all expenses, and then it discounts them back to a single present value. The core principle is just the time value of money. A dollar today is worth more than a dollar tomorrow. It helps us value the business based on its ability to generate actual cash for its owners, kind of independent of market sentiment at any given moment.
Right, and based on this educational DCF model you ran, what's the estimated intrinsic value range for TriMas?
Okay, so based on that model, the estimated intrinsic value of TriMas Corporation's equity is calculated to be in the range of $38.50 to $44.25 per share.
And what are the key assumptions that go into calculating that range?
Sure. We used a 5-year explicit forecast period running from 2025 through 2029. The initial cash flow growth rate for 2025 is based on management's own raised revenue guidance of 8–10%. Then we prudently taper that down over the forecast period. For cash flows beyond those 5 years, we used a pretty conservative terminal growth rate of 2.5%. That's often used as a proxy for long-term global GDP growth. And our discount rate, the weighted average cost of capital, or WACC, which reflects the blended cost of their debt and equity capital, was set at 9.5%.
Okay, good stuff. Now let's broaden our view a bit and analyze Chapter 4, Market Sentiment. This is where we try to gauge the market's pulse on TriMas.
Right. And Wall Street expectations for TriMas's Q3 2025 earnings, which are due out soon, they seem decidedly optimistic. The consensus EPS forecast earnings per share is $1.54. Analysts recently revised their full-year guidance upward to a range of $1.95 to $2.10. And TriMas has a strong recent track record. They beat Q2 2025 consensus by 22% and Q1 by nearly 7%. But what's truly fascinating here is, well, the pivotal question for investors seems to be whether that record-breaking aerospace segment performance is sustainable. Management themselves guided for some volume moderation in the second half due to seasonalities. The market's going to be intensely focused on the degree of this moderation, the durability of that aerospace backlog, and really the 2026 margin trajectory.
So what are analysts saying about the price target specifically? Are they generally bullish, bearish, mixed?
The consensus rating among the 12 analysts covering it is a buy. It's a mix: 1 strong buy, 5 buy, 6 hold. The average price target seems to hover between $31 and $35. However, there are some notable outliers. BWS Financial raised its target to a much more bullish $45, and Morningstar's fair value estimate is $43.35. Both of those suggest, a meaningful discount to its intrinsic value at current prices, aligning somewhat with our DCF range.
And the recent news flow, the general media tone around TriMas, mostly positive.
Yeah, predominantly positive. It's been largely dominated by that strong Q2 earnings beat, the raised guidance, the new CEO appointment, and as we'll get to shortly, reports of significant insider buying.
Ah, right. But that positive news flow seems kind of at odds with the key market indicator, short interest. You mentioned that earlier.
It is quite something, isn't it? The short interest is notably high. It's somewhere between 9.1% and 9.3% of the float. That represents almost 3 million shares sold short. With a days-to-cover ratio of nearly 7 days, it indicates pretty significant market skepticism. It's a real point of contention with the otherwise bullish fundamental story we're discussing.
That is a stark contrast. So what about the technical indicators? Where does the price chart sit relative to its moving averages?
Well, the stock price, $35.53, is slightly above its 50-day moving average, which is $35.27, generally positive, though some short-term indicators do suggest it might be a bit overbought and maybe losing some momentum right now. However, looking longer term, the price is significantly above its 200-day moving average of $31.53. That indicates a clear long-term uptrend. And a key event was the Golden Cross back on May 2nd, 2025. That's when the price decisively crossed above its 200-day average, around $24.63. Technically, that's a strong bullish signal.
Okay, let's explore who holds the reins then. Chapter 5, Ownership Structure.
Right. The ownership of TriMas is heavily institutional. We're talking about 99% of shares held by institutional investors. Top holders include Vanguard at 9.15%, BlackRock 6.24%, Dimensional Fund Advisors 5.9%. Interestingly, though, there seem to be some divergent views among these top holders. For instance, Bank of America recently increased its position, while Wellington Management significantly reduced theirs. So a bit of a split perspective among the big players.
But here's where it gets really compelling, I think. Let's talk about insider holdings and those recent transactions. This is often one of the most surprising facts for listeners, right? Insider ownership is exceptionally high, roughly 18.6%. That means management's financial interests are very strongly aligned with shareholders. But even more compelling is this surge of open market buying just in the past 3 months. You said 10 separate buy transactions, 0 sales, totaling over 1 million shares.
Wow.
That's right. And Director Sean Sedicott in particular, he's been the most significant buyer. He's increased his stake now to 14.9%, making him the single largest shareholder of the company. Other insiders, two directors, the new CEO, they've also been actively buying or receiving stock grants. This overwhelming pattern of buying by the people who arguably know the company best is a really powerful signal of conviction. It strongly indicates they believe the stock is currently undervalued.
And this leads to pretty significant ownership concentration then. The top 25 shareholders collectively control, 98.11% of the company? Which on one hand can lead to aligned strategic actions, maybe more efficiency, but on the other hand, it also carries that risk. If one large holder decides to liquidate a significant chunk of their stake, it could put substantial downward pressure on the stock price.
Exactly. Okay, now let's address the potential pitfalls and opportunities. Chapter 6, Risk Assessment, using a SWOT analysis framework.
Sounds good. Let's start with their strengths, their core internal competencies. Well, they have that diversified and resilient portfolio across packaging, aerospace, industrial, helps protect against downturns. You've got strong brand equity, reek, Monogram, those well-recognized names. Their market position seems highly defensible. Proprietary products, high barriers to entry, those significant switching costs, especially in aerospace. And they've shown proven operational performance lately, right? Aerospace division saw over 32% sales growth, significant margin expansion in Q2 2025.
Okay, moving to weaknesses, sort of the internal limitations. Despite diversification, they still have cyclical exposure. We saw that with the specialty products downturn. Their scale is somewhat limited under $2 billion market cap compared to some industrial giants. That could potentially limit economies of scale. There's always integration risk from their reliance on acquisitions, and ongoing operational headwinds, labor availability, supply chain pressures, those are real.
Right. On to opportunities, then future market potential. They seem incredibly well-positioned for favorable end-market growth. You've got the global aerospace recovery, increasing demand for sustainable advanced packaging. Their strong balance sheet gives them flexibility for more strategic M&A, expanding those high-margin platforms. There's also significant opportunity in innovation, particularly around sustainable, eco-friendly dispensing solutions. And as we discussed, the new operationally focused CEO plus the refined portfolio. That offers a clear path towards margin and, hopefully, return on invested capital expansion.
And finally, the threats. These are the general external challenges. Intense competition across all segments, that's a given, both from large players and specialists. There's always the risk of technological disruption if they fail to innovate continuously. And raw material volatility, things like steel, aluminum, plastic resins, energy costs, those can definitely squeeze margins.
Beyond that, what's the potential impact of key macroeconomic factors, like inflation, interest rates?
Well, inflation increases costs, raw materials, freight, labor. While they can try to pass some of these on, there's always the risk of demand destruction if prices go too high. High inflation can also erode consumer purchasing power generally. Rising interest rates, on the other hand, increase borrowing costs for those acquisitions they like to make, and they could slow down the broader economy, potentially reducing demand in their more cyclical markets.
And any big geopolitical factors on the horizon?
Yes, the new series of broad-based U.S. tariffs that were implemented in 2025, that represents a significant and pretty immediate external threat. Management has explicitly identified this as a key risk. It could increase import costs, disrupt supply chains, especially in deeply integrated sectors like aerospace. Now, they say they're taking proactive steps to mitigate, but the full financial consequences, that remains a major source of uncertainty right now.
Okay, let's bring it all together then. Finally, Chapter 7. Conclusion.
Right, the bull case for TriMas. It really rests on this compelling narrative of strategic transformation. You've got the new, highly credible CEO driving operational excellence, especially in packaging. There's been a decisive pivot by vesting non-core, lower-margin assets, redeploying capital into high-growth, high-margin sectors like aerospace and life sciences packaging. The aerospace segment is showing exceptional strength record sales, expanding margins, and perhaps most powerfully, that overwhelming insider conviction highlighted by a key director becoming the largest shareholder through aggressive open market buying. You combine that with a strong balance sheet, it forms a pretty potent bull case.
Okay, but on the flip side, the bear case also has its points. Valuation concerns are prominent. That elevated trailing PE ratio compared to history and peers suggests high expectations might already be baked in. There's also that significant short interest, a well-capitalized group of investors literally betting against the stock. The business is still fundamentally tied to the global economy. A recession would likely dampen demand across key industrial and aerospace markets. External threats like persistent inflation and the unpredictable impact of those new 2025 U.S. tariffs could further squeeze margins. And while the potential for improvement is clear, their historical return on invested capital has been mediocre. There's just no guarantee the new management will succeed in significantly elevating it.
So just to recap the valuation summary, based on our 5-year discounted cash flow model, the estimated intrinsic value of TriMas Corporation's equity is calculated to be in the range of $38.50 to $44.25 per share.
So what does this all mean for the outlook? As of August 9th, 2025, the stock closed at $35.53 a share. Comparing that to our estimated intrinsic value range of $38.50 to $44.25, well, it suggests the shares may currently be trading at a discount to their fundamental worth. The low end implies, about an 8% upside, while the high end suggests a more substantial margin of safety. This implies the market may not yet fully appreciate the future cash flow potential being unlocked by the company's strategic portfolio optimization and its new leadership. So this deep dive has given you, hopefully, a comprehensive look at TriMas Corporation. As you reflect on all this, what stands out most to you? What will you be watching most closely as this company continues its transformation? Thank you so much for joining us on this deep dive. If you found this valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. And remember, members can add stock suggestions for future deep dives right there in the comments, and we will pick them up. For just €4.99 a month, members get priority deep dives on tickers.
And over the next few months, we're actually covering all of the S&P 500 stocks with exclusive priority access just for members. If you just want a one-off deep dive on a specific stock, hey, just drop us a super thanks.
And just the usual reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.